Alix. Welcome to Bloomberg Commodities Edge, where we focus on the companies, the physical assets, and the trading behind the hottest commodities with the smartest voices in the business. Want to get right to that data dig here. We look at the top market stories of the week, and I want to start with the Suez Canal. So the tanker, the Ever Given, is finally freed, and there is talk that 75 to 100 vessels a day could go through. But this chart actually shows us something very different. Now, the canal chronically actually operates below its capacity, just about 50 vessels a day on average from 2007 through early last year. Even at the peak in 2008, the vessels that crossed were only about 64. And here's something else that caught everyone's eye this week. It was the launch of the MURBAN futures contract over in Abu Dhabi. It's that white line here on the chart. It's physically backed by at least 1 million barrels of daily production, according to Commerce Bank. Now, it's the first time a Persian Gulf OPEC member is actually allowing oil to be freely sold and shipped anywhere in the world. The hope is that it could become the regional benchmark, which would be key in pricing sales to Asia. But a lot has to happen, like generating volume, creating a forward curve. And right now, we're just 4 days in here into trading. No doubt the biggest news of the week in the U.S. was Biden's infrastructure plan. It's $2.25 trillion, and it means the U.S. is going to need more steel, cement, tarmac, cobalt, lithium, and rare earths. The country that makes a lot of those things, China. So consultancy CRU Group estimates that just $1 trillion of spending would meet demand for 6 million tons of steel, 110,000 tons of copper, and 140,000 tons of aluminum a year. That's one of the reasons why many analysts see a super cycle in commodities like copper. All right, let's get into the ring now. It's all about OPEC+, the group agreeing today to increase oil production gradually over the coming months, responding to both internal and external pressure for more supply in the recovering global economy. So earlier I talked to Goldman Sachs' Jeff Currie about that decision.
When you look at the rest of OPEC, 20% of them cannot reach their quota right now because of underinvestment. The fact that Saudi Arabia could cut production by 11% and watch prices rise by 40%, and we still not see a supply response in the current environment is telling you that in the very near term, supply is nearly inelastic. And those that have the capacity, which are primarily core OPEC, which is the GCC countries, and Russia, are sitting on all the spare capacity that really matters.
I'm joined now by Will Kennedy, Bloomberg's managing editor covering commodities and energy. Hey, how did we get here, Will?
It's a good question. Again, it's somewhat of a surprise going into this meeting. Most pundits expected that they would roll over production, but I think there have been a number of different influences that have meant Saudi Arabia, typically the most cautious and most important member of OPEC+, got comfortable with gradually increasing production. The main thing is the recovery. In the US, you have a combination of spending, of vaccination, of just people doing more that shows oil demand recovering quickly. People on planes, the most since the pandemic, gasoline back towards its pre-pandemic level. So that gives confidence to OPEC. There was also a little bit of political pressure, perhaps, from the US. The new energy secretary, Jennifer Granholm, spoke with Prince Abdulaziz, the Saudi minister, yesterday. And while he said they didn't directly discuss OPEC, she said, we'd like to see energy affordable. So they may have felt a little pressure from their customers. And there were people within OPEC, Russia in particular, who wanted to increase production and want to put oil back into the market. So I think at the end of the day, the prince felt that he could cautiously increase production and not risk the price gains that he's made over the last few months. And of course, higher production, if prices stay stable, means higher revenue for Saudi Arabia.
It is so interesting, though, that oil prices are actually up on this news, particularly as Saudi Arabia will also roll back some of their voluntary 1 million barrel a day cut. Walk us through what we know what the Saudis specifically are going to do.
Yeah, so they had, earlier in the year, as they tried to get prices higher, they had taken an additional 1 million barrels a day off the market in addition to their obligations under the OPEC Plus treaty. And that, of course, helped force prices up, but also gives them more policy maneuver beyond agreements with the group. And it does seem that to match what OPEC Plus is putting into the market, they're going to put that back into the market gradually over the next 3 months. So as we understand it, that will be 250,000 barrels a day in May, the same in June, and then 500,000 barrels a day in July. And what you see there, Alex, again, I think is Saudi confidence that as we get into the summer, peak demand in the Northern Hemisphere, that the market will be able to absorb that extra oil while continuing to draw down inventories, which is, of course, incredibly important to Saudi and the rest of OPEC Plus to make sure they feel like they're on top of the market.
We'll really appreciate the coverage. I know it's late there. Bloomberg's Will Kennedy. Time now for Commodity and Cheap, where we talk to one executive in the commodity world. And today it's Robert TICHIO, a partner at Riverstone Holdings. So his firm has 15 years of experience in low carbon investments and scaled companies with more than $5 billion of equity invested in renewables. It typically invests in one of these 6 things. First off, electrification of transport, like EVs, grid resilience. Then you have greening fossil fuels like methane and leak detection, agriculture, next generation liquid fuels like renewable diesel and hydrogen, and next horizon resource use like smart meters and smart buildings. Now, it's made investments in an EV charging company, FreeWire Technologies, a lithium corporation, Lithium Royalty Corporation, and a solar fintech lender, Lone Pal. And now it's going after hydrogen fuel cells. So first, let me explain how these actually work. So fuel cells take oxygen and compressed hydrogen. That creates water and heat that then powers the motor of your car. Now, they have quicker refueling times than a traditional EV and longer driving ranges. Enter Horizon Fuel Cell Technologies. It uses this technology for battery packs in commercial vehicles like buses and trucks. It has operations all the way from Europe to Singapore, Australia, and China. And now there's Hyzon, a spin-off of Horizon, which will take that technology and make their own vehicles with partners and then sell them. Its own brand in a fledgling sector. I recently caught up with Robert TICHIO, Riverstone's man behind the investment, and I asked him why he made this deal now.
You take a look at the demands on the grid over the course of the next 10 years, there needs to be other solutions besides battery electric vehicles and battery-oriented electrification. Hydrogen is not only is it one of the lowest scoring carbon fuel sources to be able to provide the fuel for the fuel cells, but it also has far fewer demands and less taxes on the grid than traditional batteries have.
I thought that hydrogen fuel cells were like really far in the future, that like there were a couple companies doing it in China, but it really wasn't taking off. Am I wrong?
First of all, you're not wrong in that. I think that was the public perception. I think that there has been incredible advances over the course of really just the last 24 months of fuel cells that are being commercialized for transportation. The application for fuel cells and hydrogen specifically extends not just in heavy transportation, but shipping and aviation as well. I think your observation is appropriate, though, because like we've seen in other renewable technologies, and you and I have spoken about this in the past, the compression in cost and the improvement in deliverability has made such significant strides in such a short period of time that the conversation around total cost of ownership for hydrogen today versus what it was just 3 years ago is dramatically different. And so the one point I'd make to you and your viewers is absolutely the gap was wide 4 or 5 years ago, and the improvement in that gap has been incredible just in the last 24 months.
Wow, okay. So there's 2 parts then I think to add on to that. So it's the hydrogen part, like where you're going to get it and how you source it and stuff. And then the charging stations where you can charge with hydrogen. Do you have investments in one of those 2 areas too to supplement Hyzon?
We haven't made an investment in those areas as of yet, although we've advanced a number of them. And in fact, Hyzon's vision for the future is to also partner with infrastructure build-out partners who are specifically focused on sourcing hydrogen. I will have to say, though, one of the attributes of the business model for Hyzon, which appealed to us, was the fact that they are not relying on the build out of a national or a continental network of hydrogen infrastructure. They're specifically selling their vehicles to customers who have already sourced their own hydrogen and who are operating in a fleet-oriented or back-to-base model. For example, a garbage truck fleet, a municipal fleet that may leave a depot in the morning, has a known route, fixed distances, comes back to the depot in the afternoon. There, you know where your hydrogen source is. You can source it locally, you know where it comes back to at the end of the day.
Even so, would you also be looking at hydrogen refueling companies and stations, or are you kind of leaving that to the side?
100%. I think not only is Hyzon itself contemplating and advancing conversations around hydrogen infrastructure. We as a firm, we as a franchise, it's an area that we've been spending a lot of time on, and I would consider it a highly attractive area for growth, not just for us, but for the entire clean tech investment community.
That was my interview with Robert TICHIO, partner at Riverstone Holdings. All right, that does it for me. I'm Bloomberg Commodities Edge. Catch me every Thursday at 1 p.m. New York time, 6 p.m. in London. Have a wonderful holiday, guys. This is Bloomberg.